Okay, as always with these events, I cram a heck of a lot of information into them, so I am greatly appreciative that you sit here for the next 3 hours and enjoy it. So, I mean, that's fantastic. I know it won't quite be that long, but this is the 10th year we've done it, and this year we all try and go and find out what's going on, and this year it's been entitled Surviving the Global Political Crisis, and it's quite apt because 10 years ago we started this because we were worried about what did turn into the global financial crisis. Now, I'm not sure we're heading into that same sort of direction, but there seems to be so much weirdness going on in the world. It's just important that every now and again we stop, take check. Now, some of the things I'll say tonight might be a bit crazy, you might think they're a bit silly, but they're not there to provoke you in anything more than thought. It's important that whatever we do in the world, we have to think about it. And this event tonight is designed to help you think each year, take a little bit of check and see what it's about. A lot to cover, and as usual we'll always start where we left off last year. It's all well and good for me to get up here and tell you all these crazy things like a lot of other people do, but we have to be accountable. We have to say, well, how did we go in our predictions, and does that therefore allow us to carry forward? Well, I'm very proud of our track record. We seem to get it mostly right. And again, as usual, we will cover the four main food groups: stock markets, currencies, interest rates and the Australian property market. Now, with stock markets, we got that absolutely 100% correct. If you were here last year, you might recall that, as usual in September, the stock market had a nice little dip of about 10% plus. Now, that could have led to panic, could have kept going, everyone was nervous. I was confident enough to say, don't worry, that will all come back. But that was really all I thought that would come back. I didn't think there was much more growth, and that is exactly what happened. In fact, what did happen is not only did they give it back, but they took some and then gave it back again. And you'll see that a bit later when we go through the numbers. So it's a little bit crazy, the stock market, and again we'll talk about that in more detail later. In terms of currency, it was heading towards 70 cents and under. It actually went down to 68.6. And I think everyone was probably surprised when I suggested it might be natural range heading back towards 75 to 80, and in fact that is exactly what it did. I think it peaked up at about 77, it's back now at about 75.5, and I still think that's the comfortable range. So we've got that one pretty well right. Now, interest rates is the one that I keep getting wrong at the moment, but at least we keep getting it wrong in a nice way. There's no way I believe that we should have had any further rate cuts in Australia at all. No economic justification. But still we had two. Now, that's fantastic for us if we're all knee-deep in debt. Great as investors. Good if you're a householder. But I'm not so sure it's the best thing for the country. We are at the record low rates of 50-odd years, so it's a great time to be active, it's a great time to be in debt, but it's a mystery as to how long this can go on. Now, we've seen the history of America. They've now been in low interest rates for almost 10 years, as we'll discuss. I'm not sure we can sustain that, but geez, let's make hay while the sun shines. So I did think that it was possible through lunatic decisions that we could have had more interest rate cuts. I didn't think it was necessary, and we had two. So I'll take that as a half mark. On the Australian property market, we were very confident that Sydney would start to cool. It was growing too aggressively, and it has indeed done that. It still has momentum, but the growth rates, as you'll see, have come off considerably. We're very concerned with the risk in the market at the moment, particularly in what we call stops, small, tall and overpriced apartments. And then there's big issues in regards to finance that are yet to roll out, which we'll discuss later. But as we expected, the market went pretty well true to form. So on that mark, we've got pretty much everything right. So that's a good starting point for tonight. Hopefully we can be just as consistent going forward. Now let's get straight into it. And tonight's topic, the global political crisis, I think is very apt. There's not a place in the world right now, including Singapore, that hasn't got some level of political turmoil. Here, it was a tragedy. I think the government has come down to only a 70% majority. Is that correct? So things are very nervous in Singapore. We're seeing overreaction with Ministry of Manpower, with visas and employment passes, stuff that we haven't seen in Singapore before. Where it's always been progressive and proactive and positive, we're almost seeing the reverse of that, which is the first time in a new phenomenon for Singapore. In the rest of the world, things are going even crazier. We've got this guy, Donald. He is highly likely to win the election over there. Is that justifiable? I would say not. Is it likely? Everly increasing every day, it is. Because he just has to shut up. Now that could be the only thing that stops him winning, is if he keeps talking. So he should just stop now and wait for the poll and he'll be okay. UK, we saw the madness of Brexit, not the exit. That was not the bad thing. I was actually one of the few people I know that was happy to see England get out of Europe. But not out of Europe per se. I was there at the time, and I can tell you for fact, there was no shaking of the ground and moving of the UK continent 100 kilometres further offshore. What they did get out of was the European Union, which was unnecessary, costly, ridiculous, cumbersome. And it's a godsend that they got out of that. They haven't left Europe, they've gone nowhere. And if you think about it, everyone here in Asia, we understand that if you have neighbours, you don't need a union to be trade partners. You have an economic community, you have APEC, we have ASEAN. We deal with each other on a constant basis. We don't need a new government at great expense and no control to tell us what to do. We all self-govern and interact, and that's what England will now do. So I'm rapt that they're out. In Australia, politics has gone crazy. We've been sacking prime ministers and we're letting crazy people in the door. You know, Clive Palmer should never have been allowed into Parliament. So thank goodness he only lasted one term. And then we've got a replacement out of Queensland. I don't know what they drink up there. But we've got Pauline Hanson reinvented now. The thing is, you might remember Pauline Hanson 15 odd years ago was all anti-Asian. I was actually one of the few people in the whole of Australia that physically interviewed her. I had a personal interview with her. And I can tell you her views were crazy. But they get aired in Australia because you're allowed to talk. And now you can see she's shifted off Asians. I think she closed the fish and chip shop and likes to get Chinese takeaway now. But now we've got a situation where she's against Muslims for some reason. Even though it's a minority, and they're an easy soft target right now with the political environment all around the world. And that's a disgrace. And she's just literally following in Donald Trump's footsteps, crying wolf without any fact or substance. And again, you live here in Singapore in a multicultural environment where it doesn't matter what race, religion or whatever happens, we're all human beings after all, and we forget that too often. You've had Greece that still is not fixed up, and again, political turmoil rather than economic or physical. It's a strange deal over there, and I've been visiting there quite regularly. There's nothing wrong at street level, but there's lots going wrong in Parliament. And I don't know if you've been following the Olympics, but that country is a bit crazy too politically. They ousted their Prime Minister. Maybe she was corrupt, maybe she wasn't, we'll see in time to come. But strange surprise, now the new Prime Minister is privatising just about everything. Someone's going to make a fortune out of the privatisation of those assets. Now, you might be a conspiracy theorist, you might not, but facts are facts. It's strange that that happens so easily. And of course, you've got the biggest mess on the planet going on in the Middle East. The war that we didn't need to have, that we had, that never seems to end in Iraq, that has now spun off into all the Arab Spring, and the mess of Syria. And you've got everybody saying, oh my goodness, look at all these refugees, we've got to stop them. Well, it's a very simple solution. Stop blowing up their houses. I don't know about you, but I would not stay in my house if bombs keep dropping around me. I too would get on a boat. And they wonder why they keep coming, because they keep bombing them. And we see now, just in the last week, the craziness that they don't even know where the bombs are landing, even though they've got the best guidance systems in the world. We're spending more on a war that is not going on than we did in the major wars in the 19th century. How can that be? The world is allegedly at peace, yet we spend more on military today than ever before. And we're told that we need to spend even more to go after and get a hatful of protagonists. When we've got elite forces with incredible equipment, why can't we hunt them down without the necessity of mass bombing? But this is the craziness of the world. Nothing makes sense. When we're in this situation where it's all got weird, there are consequences, and this is the problem with our new age. We don't respect the consequences because we're removed from them, and we have to start standing up for it a bit. Now, the biggest issue we face in the world right now is that there is no leadership. No matter who comes in, they don't ever seem to have any majority. We had Obama, who the last 4 years doesn't even have a majority in the lower or the upper houses of Parliament and can't pass law. He's been doing decree, which he's technically not meant to do. But it's his only choice if he's trying to govern even though he's not politically in power. And so you've got this crazy situation where things are being done without authority, without sense, without community. You know, you've got Australia that keeps sacking its prime ministers. You've got hung parliaments. It's just a shambles. And it's not just there, it's everywhere. It's the same. There is no one in charge. As a result, we're seeing more and more countries now have split parliaments. Where we used to have 2 majority parties just about everywhere, now more and more minorities are coming in. Now sometimes that's good, sometimes that's bad. It's good if it creates accountability and discussion. It's bad if it creates chaos. And we're not seeing any evidence either way at the moment. But I've never understood this whole, I belong to this faction. That's never made sense to me. But if someone's not in charge, if they don't have the power to pass the laws that they believe to be true, then that's not going to get anywhere any further. And we don't have to look any further than a prime example of how that succeeds than right here in Singapore. When Lee Kuan Yew took control, his success was not because of just his vision. It was because of his determination to see it through to the end, right or wrong, and then assess what needs to be done. In the Western world, we see everybody just having a conversation, and that's not helping anything. They're splitting us up. I mean, this whole argument of Muslim, Christianity, all this sort of stuff, it's just divisive tactics, so no one seems to get in the same room and have an open conversation. And that means that we don't know what's going on the other side. You know, we should be mature enough as a planet to know that we can talk to everybody and find out what is your problem. Why are you doing this? It's not always easy. It's not always, conducive, but it needs to be done because someone's not making the right calls. And you can see around the world, all these problems are not being fixed. You know, lots of conversation. You know, look at the United Nations. It does nothing every time something goes wrong. And when they ignore it, it becomes a bigger problem. And then how do you fix that? It's just crazy. But that's the system we've created. We shouldn't be worried about it. What it's done at a government level is we're now seeing spending going crazy. Deficits are blowing out into all sorts of weird proportions. You know, America, $1 trillion a year, mainly on military spend. Australia, $50 billion a year deficits. These are unsustainable. Look what happened in Greece. It went from the strongest economy in Europe in around about 2004 to the worst by 2010. How does that happen? Forced debt, sale of assets. See what happens in Brazil in 5 years' time. And the biggest thing for me is I look and see where are these deficits being spent? What do we have to show for them? No one ever minds if we spend money on infrastructure, a new highway, a whole bunch of new roads, schools, hospitals, something. But all these governments seem to be spending money on nothing, particularly in the Western world where committee after committee, royal committees, investigations, it's just waste. And there's no level of accountability, which to me is tragic. And what government should be doing around the world is helping little guys like us to protect our investments, to have a better life, to have a future for our kids, but we're all being ignored. That's not part of the agenda anymore. It's the big guys that pay the big tax, and they're the ones at times like now that benefit the most. All that military spending ends up billions of dollars of profits in companies. Now, I'm not going to complain about that. It's just a fact. It can't be stopped. It can't be reversed. It's just the way the system is. But this is what government is meant to do. It's meant to be there as a conscience, as a stop, as a support network for the little guy, not the big one. And we've lost our way completely on a global scale. Some of the reason that's going on is a mass disconnection. I don't understand how you put faction before country. The fact that you are a Liberal person or a Labor person, a Democrat or a Republican, whatever it may be, PAP, it shouldn't be your party before country, anywhere in the world. But that's how we've got to. The whole world politically has turned into a debate. It's like going to a high school debate and everyone just having a conversation. That's not how it should be, but that's how it is. We should be putting country first. Is this the right thing to do? Then pass it. In Australia right now we have a dilemma where the Labor Party is not willing to back important spending cuts and other initiatives because they don't feel like it. It's not to their interest, even though they came and made promises leading to the election that we will do this if we get in power. They didn't get in power and they say, oh, well, we don't have to do it now. That's wrong, because the country is worse off. And this is what we have to do. We have to hold these people accountable. We're crying out, we're yelling, we're screaming, we're begging, but no one's listening. So what? I don't know what to do about that. It doesn't matter how vocal we are. Even with the changes to the investor regime in Australia, we submitted submission after submission to the government. I don't think they even read them. They had committees, but they talk and talk, and then they don't listen, and they just say, oh no, we're going to do what we said we were going to do anyways. But hey, we had a meeting. We did let people speak. We didn't listen, but we let you speak. And you can see, where is this example going forward? What is that going to mean in the future to your kids? What are they looking at as reference points? There's nothing there of any high integrity or quality anymore, which is sad. So we've now only got social media and money. They are our two reference points in the world, which is even worse. You know, we should be seeing the little guy coming strong. You saw Arab Spring, apparently little people taking over, getting control back. But it's turned into a bigger mess than before. They probably would like to reverse all of that if they could. You know, we've seen in America, Occupy Wall Street, where people had their houses stolen and they went to protest about how come you took my house but he didn't go to jail. And the government didn't come down and say, oh, look, let's talk and see if we can help you. They said, call the police and evict these people from this spot. That's not how it should be done. So I don't know if the people power, which is what we were promised, is actually working. And we should be able to look at governments and say, what are you doing and why are you doing it, and is it happening? But it's a cloud of accountability rather than the reality of it. We don't really know. We get told things, and the sound bites are short, and the attention span is even shorter. I think, was it Microsoft came out the other day, or Google came out the other day and said the human attention span is now equal to a goldfish. I believe that to be the case. We forget so quickly what was there because we're busy doing what matters to us. We don't have a sense of community globally, collectively, state, or any other level. It's a sad thing. And it'd be nice if we could find out the truth every now and again. I'm not ever sure we do. We're just told what we're needed to be told, which makes it hard. Now all this sounds like doom and gloom. I'm not trying to scare you. Quite the opposite. I'm trying to make you aware of the environment that we live in. Because if you know the environment, then you can perhaps survive it. Knowledge has always been power. You probably know all the things that I've just pointed out. But what we do with them, how they make us react in our investment choices, in understanding what's going on, particularly with our money in our lives, is critical. So the first part of tonight is really about awareness. We can't change any of these things that are going on. That's been proven. People have been protesting on our behalf to no avail. But what we can do is create awareness and strategise to make sure we're at least somewhat protected. So moving into that, I suppose the key is having some sort of reality check. Now, you should firstly, every time you see these crazy things going on, just ask yourself one simple question. Does it actually make sense what they're saying, what they're doing? There's not much that does, but if it doesn't, don't follow them down that hole. It's a very simple thing. When you hear how bad things are, ask yourself, did you feel it? Just because you heard something, that doesn't mean it's true. And even just in life, anytime someone tells you someone said something, I wouldn't take that as gospel, because it could be misinformed, it could be misconstrued, it could be deliberate. Go and find out for yourself. See, talk, ask. And find out, why are they telling you this? Is it because they care? Is it because they're going to make money out of you? Is it because they have a particular vested interest? You need to know that. Even today, you should be saying, well, why is he telling me this? We're just trying to keep you protected. We're obviously looking after you, our existing clients. We want you to be safe. That's the most important thing. But you've got to ask politicians, why are you doing this? Why are you pushing that barrow? And if there is a particular motivation, you should be aware of it. Everybody will get paid out of something, either a commission, a fee, a charge. That's normal. But is it fair and reasonable? Is it enough to influence the way I would present to you, to distort the truth and sway your opinion? That's what we have to ask. And try and go and gather as much of the information as possible. I see time and time again, everybody reads the headline, not the story. And even the headline these days doesn't actually reflect what the story is. It used to have integrity in journalism. You could rely on what you saw on TV, what you read in the paper. No more. So it's now your duty. Now, the Google and the internet is fantastic. It theoretically gives us access to all the information we need, but what you have to remember is some of that information is not necessarily true. It's either opinion, it's construed, it may be factual. The more you find out, the better off you will be. And you've also got to say, well, what would happen if they are right? Brexit was a classic thing. If you remember when Brexit was going on, the whole world was told, if England leaves, it's the end. The economy will collapse. Everything will fall into a mess. It did for 7 days. 7 days. Someone made a fortune with the stock market collapsing for 7 days and recovering 7 days later. That's how strange it is. Is it real? I don't think so. You see, my little mate there, he's living in the virtual reality world. That's what they want us to be. We need to live in the real world. And that's where you can exercise something that nature gave you, instincts. You can trust your gut. If it sounds about right, if it feels about right, it probably is about right. But if it sounds crazy, maybe it is crazy. Don't be convinced out of it just because someone thinks that they're right. No one knows what's going on now. It's up to you to decide what's best for your situation. Moving to the stock market, that is probably the easiest place to be evident of what I'm talking about. Now, it's a strange world that we live in, and we have these things called stock market crashes. We started this seminar program 10 years ago because we felt that there was a stock market crash around the corner. That turned out to be absolutely correct. But even myself at that time, there's no way I would have predicted that it was going to be a 30–40% collapse. I was thinking 10, maybe 15. But they pushed it all the way to 40% and took all of that money back the next year. We predicted the recovery of it as well, which was very good for us. But, so many people got caught out and are still paying the price of that today. I don't think we're looking at another crash in the near future. And one of the key reasons for that is they're taking it in pieces along the way. A stock market crash is the ultimate way for wealth distribution. You can push it from one side to another very, very quickly. But you'll see later with the stats, they're moving wealth very quickly already without the need for a crash. And they've got us well trained in that, you'll see it. And of course, if you're watching the stock markets, if you're watching all the TV shows that are everywhere, the newspapers that are everywhere, you'll see that the same people pushing the same opposite arguments on a constant basis. Today I'm for, tomorrow I'm against. The stock market will go up, no, I think it'll now go down. That's just crazy. And I've always said, this goes right back to the initial seminar, if you see a high-level executive from a hedge fund, from a management fund, from a share broking firm, on TV telling you what he thinks will happen, there's a high likelihood that that's probably the opposite, because that's what he wants us to do rather than what he thinks will happen. Because let's face it, if you were that person, or if he worked for you and he came back to your office and he had just given all of your trade secrets to the whole world, I think you would sack him, wouldn't you? Why did you tell him we weren't ready? We want to profit, not the rest of the world. You'd be sacked. But they come on, volunteer their time. It's wonderful. So kind of them to do so. But you've got to be careful when they keep flip-flopping. And they're also making us, freak out. We see what should happen and the opposite occurs. And that makes your mind start to spin in total and rampant confusion. A classic case was National Bank's profit going up by 25%, went from 5 billion to 6 billion, 20% uplift in profit. Its share price went down 20% soon after. That's not logical. That should not happen, but they have the power to make these things occur. The dollar moves in a direction counter to what the interest rate may have done. That's, if there's a rate cut, the dollar will go down. The rate cut happens and the dollar goes up. So how can we at all be ever correct when the things that are meant to occur logically are not occurring because they can be manipulated by big forces? And the secret with the stock exchange is to ignore the noise and just look at the facts. Go and look at genuine yields. They're calculable using a thing called mathematics. It's a crazy thing. You should get used to it. If you're not good with it, they have calculators now. Even on your computer and your phone, you can use a calculator. It's a fantastic tool. So go and calculate, what is my yield? That's like an interest rate. Because if you've got a high yield, that's probably telling you it's good value. A low yield is telling you high risk. So you want to look for things that are giving you high yield, especially in the world we live in today where interest rates are so low. So if you're earning 0% on your money and you can get a yield, a DBS of 5%, hold on, so if I give DBS $1 million on deposit, they pay me 0, but if I buy shares, they pay me 5%. Where I come from, there's a saying, there's a message there somewhere. You know, you should look for yield because that's what puts food on the table. You can eat a dividend, you can't eat growth. So you need to look at that, and you also need to look at value. You saw classically just a couple of weeks ago, I think Microsoft bought LinkedIn. I don't know if you saw the headlines there, but what they did was amazing. It was an astounding achievement in corporate due diligence where they bought a company for twice the value it was the day before. So they came out and announced with great pride that, look, we bought this company for twice its value because we think it's a great deal. And the world said, we agree with you. Now, I don't know about you, but if someone pays twice as much for an asset, I'm sacking that person. That's not going to be rewarded in my world, but this is the confusion that we live. Their justification is that we think it's worth more. Well, who are you? And whose money are you using? Mine as the shareholder. So why would you do that? But this is what it is. You have to look closely at these values because no one these days is looking at things like market capitalisation, which is the number of shares issued times the share price. They're absurd, some of these valuations. Billions, trillions of dollars for companies that do nothing. Some of them, they're paying billions of dollars to buy and they don't even have a turnover, never mind a profit. That doesn't make sense, but this is the modern age we live in. So you need to think beyond what they're telling you and say, well, what am I buying? Is it good value? It's no different to buying a banana. If you go to the store and you see bananas are on sale, you buy more bananas than you're probably going to eat. But if you see them and they feel expensive, you say, oh, even though I love bananas and I need them, they're too expensive today. Imagine if you applied the same theory to shares. Maybe you'd never lose money. You know, but some of the monkeys are buying them. And you can see here in the stock market, you know, it's a rodeo ride. You know, and you can see here, this is just over the last 2 years. In the last 2 years, we were around about this point last year. And you can see the stock market had come off significantly just before we started the seminar. And I said, hey, don't worry, it's not a big thing. They've just taken a little bit off us. They're going to put it back. And that was why I was very confident to say, hey, we'll get that back. You can imagine a lot of people would think, are you crazy? That's a huge fall. But surprise, surprise, it's totally all back. They even gave a bit more back, but they took it back off us. And you can see they decided it was so much fun taking it, they did it again. Now, there was no logical reason that you could find as to why that occurred, but it did because it can. And this is it. Logic is not there. Now, if you had sold your shares out of fear, someone else makes that profit and you make a loss. But what you need to do is if you see things that don't make sense, don't be pushed into panic reactions. That's the secret. Now you can see in the last 12 months, there's that second dip. There was the recovery, and then in January they said, hey, let's go. Now, the cynic in me says, what a coincidence that it was after December that the second grab did, because the reporting seasons are quarterly. So 30th of September, one quarter, 31st of December, get the recovery, numbers don't look too bad. Then as long as we do it in January, it's got till March to fix it. And more or less you can see they started to get the climb up in March. So you've got to be very mindful that the Dow is not really a very good indication. Now just to give a reference point, the Dow, which we're trained to look at constantly and constantly, does anyone know how many companies are in the Dow? I'll tell you, it's 30. 30 companies make up the Dow. Do you know how many companies are on the New York Stock Exchange? Almost 3,000. So 30 companies as an index for 3,000. That doesn't quite make sense. But again, easy for them to push it on us. So you don't want to look at indexes, you want to look at individual companies and individual value. Now you can see here, 10% on the year, double-digit growth, but it wasn't really growth because they had taken 10% off us just prior. And all it was the 10% coming back. And that was primarily a lot of wealth transfer, usually out of our pockets into theirs, if you have managed funds and areas that you don't know where your money is. And that's why I'm a great believer in direct shareholding, where you control the buy-sell decision rather than allowing someone else to arbitrarily make that for you. But it's personal choice. Some people think it's too difficult to buy and sell shares, but there's this thing called the internet that has changed it. They have all these online share things. You can do it conveniently, easily, without any fear of anything going wrong. Now, if you look at, say, why I'm still confident in the stock market, I don't think there is any reason to be fearful of it. And here are the two things that matter. Price-earnings ratio is how many years of profit to pay for the share price, and the dividend yields is basically a good indicator of the profitability of a corporation, but the dividend yield is usually only about half to two-thirds of the actual after-tax profit. They keep some for future growth, as you would see. Now you can see, here we are, this is the worst point in history of man. This is the GFC in 2007, 2008, and you can see here we're now back, when it comes to PE ratios, around those levels. In fact, we're a bit over them. So theoretically, we should be a bit nervous that the stock market is maybe overvalued against those indexes. Now, the PE ratio is based on current, but the market perceives, should I be more confident in the potential of tomorrow, and therefore I'm more generous in a higher PE. I'm willing to extend it out a bit. So it's a little bit of a measure of confidence and sometimes a measure of stupidity. So it's a bit of a mixture of the two. But you can see here we're dangerously close to where those PE ratios were pre-GFC. Now, the reason I'm not concerned overall that, oh goodness, we're about to go the same path, is you can see the dividend yields aren't. The dividend yields are still quite high, which says that the PEs are justifiably a little bit high because the profitability is ever increasing. So what that's saying to you is there's underlying genuine profit in those entities, and so you can afford to be a little bit generous. I still wouldn't be that generous, but the market overall says that if you've got good dividend yields that are still not too low to be dangerous, that we probably still got a little bit of legs in this market. So as a result, even though I have a level of nervousness on some valuations, I'm still quite confident that the prices aren't ridiculous. But the key is to be looking at high profit corporations, good dividend payers, so that even if the market doesn't go in your way, even if you do lose some money on the value, that if you're getting a regular dividend, you won't care because you'll have constant revenue coming in. And you can see here, this is the companies that I put up each year, and you can see in 2016, BHP continued on its losing way. I suppose not surprising because commodities were going down, but what a bad company if you only make $4 billion. I know that's terrible. You've gone from 13 the year before, but I hope I can do badly and make my profit $4 billion. I wish I could do that. I'm sure you would too. You can see HSBC, doing terribly in the market. $17 billion of profit. But its share price has been hammered because it's been caught out doing a few naughty things, but they write out the checks. You can see Bank of America, its profit shot up, but it's still its share price technically went down only 1%. That doesn't make sense. So that's that illogic that I'm talking about. There should not be a reason why you have that big kick up in profit that you don't get a corresponding uplift in price. And you can see CBA, a minor increase in profit, but its share price went down. Now, the Australian bank shares, I've always used as my benchmark. I consider them to be the safest stock in the world. They've been hammered this last 24 months. They're off 20, 30% from their previous high points. I don't think that's because they're bad. Their profits have been going up, their businesses are sound, everything's looking rosy, but they are the highest yielding stocks literally on the planet, And so the big money wants to say, let's buy those. But they don't want to pay full price. So they can talk them down, buy them now, and away we go. I thought it was very interesting that just last week, Goldman Sachs, highly credible organisation, put a buy order back on Commonwealth Bank Australia. It's been saying, oh, we don't like it very much for a while, and this is that whole flipping sides. Miraculously, now that it's a very cheap price and they've probably bought lots of them, let's put a buy order on. They're good again. But the thing is, nothing changed at Commonwealth Bank in the last 12 months. So they were a good buy yesterday. They're just great value today. So you should load up before Goldman Sachs start pushing the price up too high. You can see Microsoft, an amazing company. Its profit's $16 billion. Its share price went up 30%. I bet you wish you were Bill Gates. Goodness me, but it's just a Goliath. Now, you can't knock $16 billion, but if you look at its value, it's still pretty frightening. And Google, it doesn't even pay a dividend. Its profit's $16 billion as well. Its share price up 23%. You can see this is where it's strange. Some are losing, some are making, and none of it makes sense. Because the share price is not controlled by any natural factor. It's controlled by market forces, sentiment, traders, feel good, feel bad. It's not the best indicator. You can see Pfizer doing nicely, it's $7 billion profit down, its share price is up. Coca-Cola, steady, 10% up. Most of that just that corrective. You can see if we look at the overall index, the Dow was up 11% over that period. And I benchmark this each year on the 9th of September. So 11%, that whole recovery that I mentioned all came back. So last year we were 4% down on the 9th, this year 11% up. Now, I'm not a genius when it comes to shares. I'm not trying to tell you that any way, shape or form. I'm just a logical person with mathematical ability. So that's all that this is. It's looking past the rhetoric and the talk into the reality. And there's the All Ordinaries up 4% after 6 last year, and the FTSE, which should theoretically be in the doldrums, because apparently Brexit is the end of the world, but that's up year on year. So how can that possibly be if it's so bad as the Londoners would like you to say? The rest of England, they don't care, but London apparently, centre of the universe, they do. But you can see here, 8% up year on year. Now, my prediction, first one of the night for next year on the stock market, I think we're going to have a modest growth year. I don't think we're going to see too much volatility, but there are going to be some takeouts, and we're probably going to be very similar to 2014, where we had a decent year the year prior and we had a softening off of return. So I'm expecting to be a bit softer return, but there'll still be that volatility because they can. Don't be surprised to see some 5–10% corrections, but as usual they will be short-lived because they go down, the wealth moves, it has to go back up for full transfer to occur. So prediction number one, stock market normal, soft growth. Now a lot of people believe in numbers, and 7s apparently are not a very good number for stock markets. So there's a lot of people saying 2017, next year, about this time the crash is coming. We'll have to keep a beady little eye on that because don't forget it's what people believe that matters. So if all the people believe that 7 is unlucky, it usually becomes that. Same like as so we live in a strong Chinese community. They all think, oh, number 8 is lucky. Now it's not that number 8 is necessarily lucky, but if everybody believes it to be lucky, then it becomes lucky. And that's the power of all banding together to create your own reality. But the stock market, I think, will be quite okay this year. If we look at currency, wow. I think most of people did not think I would be anywhere within cooey when I said 75 to 80 cents. But I'm glad I was right, because I might not have put the seminar on. We might have had to just cancel it. But, 75 to 80 cents is what I think the normal level. There's no real reason for that. I just think it's a sensible positioning to be in. It's a fair indication in my gut. And I trust my gut. There's no logic to it. And my main justification remains that although the US economy is in a good position, it's got good job levels, it's growing at a reasonable rate for a Western society, the issue is not the economics, it's the politics. You can't keep running those massive deficits that China is now no longer funding, and keep borrowing and printing and borrowing and printing and expect your currency to stay strong. It is not logical to do. But having said that, we've just spent ages realising that logic doesn't matter much. But you can make something unnatural for a reasonable period of time, but eventually nature will win. And so you will always come back to where it should be, and that's where I think we are now. You can see Australia is a commodities economy and allegedly got taken down because of the commodities. But the Australian dollar should never have been at 90 cents US, 95 cents US, $1 US, $1.10 US. There was no logical reason for that to be either, so it was no surprise to see it come back to $1.95 and now settling in at 75 to 80. Now, commodities should improve because there is still huge demand. And you might recall a few years ago, the annual update was entitled The Forgotten Law of Supply and Demand, because at the end of the day, that's all that matters. Does someone want to buy it and does someone have it to sell? Too many buyers, not enough sellers, price goes down. Too many sellers, not enough buyers, price goes up, whichever it is. So you've got to look at that. And commodities, I don't think, can get much lower. And there's still huge demand. We're going to be, I think, still very, very volatile on the currency. We're seeing half-cent shifts on a daily basis, 1 cent shifts every now and again. And that should not occur. But I think what's going to happen is we're going to be moving up and down those half-cent 1 cents in a tighter band. Instead of it being $1 down to 60 cents, it'll be that 75 to 80, but maybe go from 72 to 78. So the band will be tighter. And I don't think that when I look forward, not that I'm any real expert on this, but when I look forward, and when you look forward, that there's anything that we can see that is potentially problematic. You could say, oh yeah, but commodities, yeah, but they're not going to get much worse than they are now. Oh, the US, yeah, but it's already a pretty big mess. So I think everything that's potentially out there to hurt is already within sight and visible and being influenced. So we don't need to worry too much about it. You can see in terms of the currency, this is the last 2 years, and we've gone from that 85 cents. And if I'd gone back a bit further, 90, 95, $1, and here we bottomed out at 68.6, and now we've come back into this 75 to 80 cents band with a short period of correction there. And that's what I think we're going to see. I think we're going to see it now move in this range of that 72 to 78 cents, but it should be comfortable in 75 to 80. Anything could happen. Interest rates are obviously going to be an influence, whether the US puts it up or not. But I don't think they can afford to put it up because they've borrowed so much money. So that's half the reason they're keeping it down, which we'll look at in a minute. But overall, I think we're pretty much in the zone. In terms of the Singapore dollar, that still remains a bit of a confusion to me, because the Singapore government is very, very sensible in its strategy on currency, and it did soften against the US quite a bit, or strengthen against the US. So it's harder to predict where all that will be. It could be more influenced by governmental decision making as opposed to market forces. There's a soft peg there, but they do manage it to suit the economy. Maybe not as well as they did in the past, but again, sitting in this $1 to $1.05 is probably a more comfortable zone that we're used to. I'd like to see it personally at $1.10, but I'm not sure I'm going to get my wish. I think I'll have to stay in the reality of $1, $1.05. But if it stays there, we'll all be okay. So my prediction moving forward on the US to the Aussie is going to stay that 75 to 80 again this year. We'll see how that goes. And the Sing dollar, $1 to $1.05. Now, if we have a look at interest rates, this is one that I probably got a little bit wrong for not the first year. It's now probably been a few years since I've got it wrong, because they keep pushing Australian interest rates down to new depths. I don't think there's any logical reason for that, especially when they seem to be primarily concerned about housing prices. So if you're worried about housing, you shouldn't be fueling the market with cheap finance. But that's what they keep doing. They allegedly can't decide whether they want to keep housing prices normal or allow construction to be the dominant economic driver of the country. And it's a dilemma that they cannot seem to balance off. It's a real problem in Australia. But you can see in the rest of the world, there's the US. It's had 0 to 0.25 interest rates for ages. And here in Europe and in Japan, it's now negative interest rates. So what that means is, I go to the bank and they say, here, we'll pay you to take this. So, pardon? What? Hold on. Where do I get that loan? I want one of those. But of course, do us little people, do we get those? No. Sorry. They get that at negative, and then they put big margins on and lend it to us at 4s and 5s. Oh, hold on, where's the governmental protection? Oh, that's gone. That's gone. It doesn't make sense, does it? That's not right. You think that they would share the benefit? I don't think so. In the US, you're still borrowing at 4s and 5% on home loans, even though rates are allegedly 0 to 0.25. You know, Australia, the margins are quite wide. We're 1.5, I think, on the base rate now, but you're still borrowing cheaply. The cheapest is about 4. That's a pretty wide gap. Someone's doing all right. Oh, hold on. That's right, Commonwealth Bank's profit just went up a whole bunch, and National Bank's profit. Note to self, maybe get some of those. But you can see here, this is the strange world we live in. We're down in this new age, and it's just a matter of how long can we be there. Now, traditionally, we haven't ever stayed at low interest rates for very long. So we're in uncharted waters right now in Australia. I hope it hangs around for a lot longer, because I've still got lots and lots of debt on all my lovely properties. But I would not be surprised to see it start to change within 12 to 24 months. Now, hopefully it'll be a soft and gradual uplift rather than the harsh lifts that they've had in the past, which have been foolish and damaging. So we'll have to see what goes on. But there is certainly no sign from the RBA that they are uncomfortable with interest rates at these levels. So there is nothing there to suggest that we will not have this lovely, wonderful, cheap interest rate environment for a reasonable time into the future, which is fantastic news for homeowners, investors, for anyone. It's terrible news if you like to live off a thing called the term deposit, because the whole world is getting paid hardly anything to leave its money in safe protection of bank vaults, which again seems ludicrous when there are high dividends out there to be got freely and openly. So we'll see. Again, inflation is one of the key reasons the RBA is happy to leave interest rates at these current levels, because it's low. But again, I continue to question that, you know, seminar after seminar as to the reality of that lowness, and I'm not sure that is sustainable either, particularly in Australia, where things don't seem to be getting cheaper in my mind, but maybe I'm just looking at the wrong things like milk and bread and all the rest of it. Those don't seem to be working out. But we'll see what goes on there, because whilst inflation is technically low, the RBA will be confident to leave interest rates low. If they start to see it creep up a bit, they might have to start bringing in interest rates to soften that blow as well. So we're living in a strange time where inflation is no longer any sort of bearing on an economy, I think, and hasn't been for quite some time, but the RBA is still looking at it in those ways. To me, what that's all meaning is that you can be a good time to be a borrower. So my prediction on interest rates is that we're not going to see in the short to medium term, in the 6 to 24 month, any significant uplift in interest cost. But what that means is that you should want to be a borrower. And you can see here, currently on Australian property, if you're an expatriate, you still can get some financing options, but they're tightening up, as we'll talk about in a little while, all the time. As a foreigner, you're down to 70%, and in truth, it's very, very hard now to get a loan if you're not an Australian and you've bought an Australian property. It's very, very hard. There's only a few banks, as I'll show you in a minute, that are doing it, and when you go in and apply, very few people actually qualify. It's more like an advertisement than an opportunity. Now you can see for an expat, with these low interest rates, the holding cost on a $600,000 property with an 80% loan is now down to $600 a year. Servicing the loan, collecting rent, paying all your expenses, $600 a year holding cost. Now in Australia, everyone's chasing that magical thing called a cash flow positive property, because we have a concept of negative gearing. Our expenses are usually more than our income, but almost every normal property now is almost cash flow positive because interest rates are so low. And I'm using the fixed rate for 5 years, which is now 3.99. So if you are not sure where interest rates will go, you could fix and take that question mark off the table. So $600 a year. Now, foreign investors are lucky if they can get 70. Now, you can see what that does is your return after tax and costs and interest, just by leveraging at 70%, drops a lot. Now, that's primarily because of the leveraging, but also because foreigners now have much higher costs of acquisition. There's new fees, there's a $5,000 acquisition fee, and there's new additional stamp duties, which I'll talk about in a sec. But it's taken the entry costs from 26 up to 55,000, and this particular one was in New South Wales. So that's added a lot to it. Now, that's obviously impacted on the after-tax return, but the longer you hold it, the better that will be, because those initial costs spread over a longer period will start to diminish in the takeout of your gain. So it still pays to do it. And if you can't get finance, paying cash is still attractive. Assuming a 7% growth on the property, it's 5.5%. Now that's attractive compared to a 0.001% interest rate on the money in the bank, but it's not very attractive to what used to be available to foreigners to make the same property, the same situation at 15%, and there was equality between Australians and foreigners, expats alike. Not anymore. That equality is gone, and I think that's a foolish decision on the government's part. But you see, with interest rates being so low, particularly if you're lucky enough to be an Australian citizen or permanent resident, you should be okay. As a 70% lend, you're still very attractive at just under 10% growth, but as a cash buyer, it's starting to diminish its return. Now, I don't know what's happening there. So this is something we need to be very mindful, and again, it comes down to what we'll talk about in a minute when it comes to property. Selection is getting more and more important, and we'll see how it goes. Now, these investors are now from overseas being targeted by everyone in Australia. They've been copping the blame for the last few years of prices going up, and I keep reminding people that is simply just not true. And the reason I say that is very easy. Foreigners have to buy brand new property, and that brings new supply into the market, and the only thing that can hold back demand is new supply. If you've got strong demand, which you do have, particularly in Sydney and Melbourne right now, and there is no new supply, then prices must continue to rise. The new supply that's being brought in, particularly from foreigners, is tempering the growth. Without that, the growth would be even more. So we should be thanking them, but in Australia, we're penalising them. All the state governments are looking at it as a massive cash cow. And what's happened is Victoria has now lifted their foreign duty up to 7%, New South Wales to 4%, and Queensland now 3%, starting in about a week or two. Now, Victoria was the first one to do this. It brought in, I think it was a 4% duty last year, but it wasn't a big issue because Victoria had a stamp duty concession if you bought off plan. So it was lower than everywhere else in Australia, so bringing in that foreign buyer's duty basically just meant the foreigners paid the same that they would have paid in any other state in Australia. But now they've gone and further lifted it to 7%, so foreigners are now at a much greater disadvantage. Now, having said that, we're still much less than the Singapore foreign buyer duties, the Hong Kong foreign buyer duties, and Canada, where Vancouver has just brought in a 15% foreign buyer's duty. So we're still cost effective if you look at it on a world scale, but we're being disrespectful. And that's the big problem to me. Australia is not appreciating the contribution, they're being disrespectful. So this needs to be done. Now the big issue here is that the federal government is also whacking another $5,000 on if it's under $1 million, and a $5,000 additional for every amount, or $10,000 additional for every amount over $1 million. So it's coming from both sides. What used to be a no-cost purchase is now a high-cost purchase. Now the state governments are making a mistake in doing this because it's just going to stymie the growth. Now, at the same time, there is protection mechanisms being enforced, not introduced. They were always there, but we're now seeing them policed aggressively. Foreigners, as I mentioned earlier, can only buy brand new, but every now and again someone tries to be sneaky and gets in there and uses a company or a cousin or a friend and pretends that they didn't buy it, but they did. they're now being found out and penalised at great extent. $125,000 per time, and you're forced to sell the property, and the government keeps 25% of the sale proceeds. So I don't think there's any encouragement now to be naughty. You shouldn't have done it in the first place. You shouldn't do it again. And more particularly, I'm very happy is that anyone like me that helps someone do that, a real estate agent, a lawyer, anyone that helps someone buy a property that they weren't entitled to, they also get that same fine. And I'm rapt about that because in 20-odd years of having the opportunity to do that, we didn't do it because it's unethical, it's illegal, and it's just immoral. So we didn't do it. But believe me, there are others that did, so I'm constantly dobbing them in, and you can too. If you find anyone that bought illegally, dob them in. They'll be forced to sell the property, you might get a bargain. So that's a good thing. But at the same time, what's happening in the community is that the lending options for foreigners are drying up. So the state governments are thinking, hey, we're just going to make good money, we're going to charge these extra fees. Hey, I think New South Wales alone believes it to be worth $1 billion in additional stamp duty collections just by charging the foreigners. But if we've taken away the opportunity to finance these properties, they may not complete. And what a lot of people don't realise is that in that sale price, there is approximately 6% of it that goes to the government as net GST collection, and that ends up in the state coffers. There is the normal stamp duty of approximately 5 to 6%, which ends up in state coffers. And then there is now the 3, 4 or 7% additional duty that goes to the state in that price. So that is in, upwards of 15 to 20% of any purchase price for a foreigner is government revenue alone. But only if you settle. And this is the mistake they've made. They've made it difficult overseas, and if those people don't settle, the property stays with the developer and the government collects zero. So you should be seeing in the next little while a massive about-face in government policy when the penny drops and they realise how much they have now at risk of collection if they don't provide support finance. It's a big, big issue. To give you an idea, this is what it used to be. You used to be able to get finance everywhere here, 80%, and this is what it's now, zero. Only one person is lending is Citibank, I think, for non-residents, and to get a loan from Citibank, good luck with that. They really don't want to actually do it, but they are theoretically the last man standing at the moment, but not for much longer. Now, some of the Singapore banks are offering finance facilities there for both PRCs and also Singaporeans. But again, to get approval on that using the Ministry of Money guidelines is almost impossible. And they can't do it for anyone unless there's a direct connection. So it's so hard now to get a loan, and that's why what we're doing is instigating our own bank. So we've been working hard on that. That's about to come out. Hopefully around about January we should be launching that. So if you want to get involved, make sure you do that. It could be the best opportunity of our lives, because look at the volume. You might recall last year's update seminar was entitled, the Asian invasion. We thought it was an invasion when it hit 24,000 purchases for foreigners. Last year it jumped from 24 to 38,000 foreign purchases. Hence why the governments are saying, hey, look what we'll make if we charge that 3, 4 or 7%. We'll be rich, but only if they complete, because otherwise you'll be poor. So there is an enormous amount of activity, over almost $100 billion worth of sales, that now are going to struggle to get finance. Someone has to do it, it might as well be us. But obviously there is risk in the market if these sales, which are contracted and bound with a 10% deposit, do not eventuate into completions and settlements. Developers won't get paid, they might have pressure from banks, the economy suffers, the government doesn't get the revenue. It's a snowball effect, and hence why something needs to be done, but they're all asleep at the wheel except for us, so we'll see how we go. Now, we need to get some level of protection here, and that's what we're working on. We'll see how it goes, but this is still the tip of the iceberg. Now, I'm expecting, obviously, if you can't get finance, sales activity will diminish. But even if it halves, even if it quarters, you can see we traditionally do 4,000 or 5,000 sales a year to foreigners, jump to 10 to 38. If it quarters, it's still down at almost 10,000 sales, which is still twice as much as it used to be. Now, the reason they're buying isn't just because of opportunity, it's because it is the best place in the world and still is the best value for nice anywhere. You can buy horrible cheaper everywhere in the world, but to buy nice property in nice locations with nice views and nice blue skies, Australia still stands head and shoulders above. One of the things that's very interesting is that our population, which I've always said is the reason we're safe as a property market in Australia, our population is actually still slowing down. So the growth there has come from what was 1.7 and peaked at 2.1% down to now 1.4% a year. Now that's still a substantial amount. It's 300,000 over population growth, of which roughly half is births, half is migration. But that slowdown is also a bit of a problem economically. And Australia is in this dilemma that they don't quite know what their migration policy should be. Do we get larger or smaller? It's a dilemma. There's pros and cons for both. But to me what's very interesting is that 38,000 people last year, just as an example, said, I'd like to buy an Australian property. Mainly from China, 25,000 of them. That's approximately 20% of the migration. These are people that aren't migrants, but now they have a connection to Australia. Now maybe not tomorrow, maybe not the day after, maybe not next year, maybe not the next 5 years, but that connection will get stronger and stronger and stronger every year. How do I know that? Because that's what's happened in Singapore. Singapore's been buying Australian property for 25, 30 years, and they go down more and more, the connection is stronger, that's what's going on. As people get familiar with how good Australia is, you'll probably find that those owners will spend more time there either as transits or permanents. And you'll find the migration will start kicking up again. And I remind people that a lot of the reason I think the migration has slowed off is because the US dollar strengthened. The opportunity was greater overseas than in Australia, so it's making money before you go. There is still an enormous amount of PRs waiting to arrive, and people forget there is a 5-year time before you have to come down from when you activate your permanent residency. So there's a lot of people about to come, which is one of the reasons why we surged previously. And it always peaks out in the first quarter of the year, 31st of March, because of school. It always has, it always will, because Australia is a family-based place. You don't go to Australia to make your fortune, you go to Australia to have a great time with your family. There's no better place in the world to go. But the trend is still on the decline at the moment. Now, this is an important number because if we keep building too many houses and no one turns up, then you will end up with oversupply, which is not a good thing. So we want to see that population start to balance out to keep pace and strengthen the market, because we can't just build for the sake of building. There's a few other places that I can think of that build for the sake of building. I don't know if you know any of them. So on the way home, just keep looking upwards. If there's anything more than 20 stories, you're probably building for the sake of building. But in Australia, I think we're going to still get a good kick from the natural migration that has slowed and will come back, and then all these new connections to Australia that, if we respect them, which we're not currently doing, we'll say, hey, I think I might move to Australia. And they're all going en masse. The reason they're doing it is pretty simple. It's still the best place in the world, and you don't have to take my word for it. It just keeps going on. Now, Melbourne, again, is the world's most livable city. Sydney actually went from 7th to 11th. It dropped out. Not because it got not very nice, but this is the thin line that we live in today. Because Sydney is perceived to now be a little bit more risky because of a few terrorist acts and the activity going on there, it's moved 4 places because of that. It's a sad indictment of the current lifestyle we have. We are creating these problems. So it's dropped 4 places, it's dropped because of a few minor acts. And that's why it's so important that we keep sanity in the world, because that's what we all want. No one wants to have issues. Everyone wants to just have a nice life, live happily, look after your kids. But this whole livability factor is Australia's secret weapon, and Perth is sitting there at number 7. It went up. Everywhere else is holding line. It's the best place to be. I was lucky enough to be in Perth last week. It's still gorgeous. I now call it best in Australia. It's just miles better. And you might have noticed that Perth, WA, didn't have a foreign stamp duty surcharge. So if you are wanting to invest, don't give your money over to New South Wales or Victoria. Go look at Perth. Opportunity astounds there right now. You can see overall the world has had a pretty good year for property, not surprisingly, and we predicted it. You know, Hong Kong has come off, officially 8.5% year on year, but if you're spending time in Hong Kong, it's actually come off significantly more than that, I would suggest. You know, not just because of natural end of cycle, but it was massively overheated. It had to normalise out. But Australia and everywhere else is doing pretty well. New Zealand doing fantastic thanks to the new Lord of the Rings films. You know, what is it, The Hobbit or whatever? The Hobbit. You know, that's all always happens. That's the Hobbit factor there and the Lord of the Rings factor. But you can see, you know, the whole world is normally doing okay. You know, and there's no real reason for concern in any real market. Now Singapore, you know, also here is a bit soft right now. It's come off, you know, 10-15% or more. But we're not seeing any stimulus. Again, in the past, if you think about it, governance here was very strong. When they saw, you know, slowdown, they introduced speed-up measures. In the last few years, we've seen slowdown measures and they forgot to do the speed-up. So we're not quite sure when they're going to turn the button back on, but we'll see. But overall, the whole world is normal, and Australia in particular is. We are now the longest, you know, running country without a recession. No one else has gone as long as we have, and the economy is improving. Although, again, if you read the newspapers, you'd think that Australia was doing terrible because they all say it's not growing enough. It's growing nicely. Nothing's wrong there, and sentiment is also on the improve. Now, it doesn't matter that it's deserved or not. You know, political confusion aside, it's that fact that we've got 1.4% population growth. We've still got a resources boom going on. It's a resources output boom, not a resources investment boom. We've still got the best farms. We've still now got the best milk. Everything's the best in Australia because we're isolated. You know, a country as big as America with only 24 million people is hard to spoil. Our property markets are running very true to form. You know, and Sydney is at peak or past it. I think it's actually moved into the delicate point, but it's a split market. There's the owner-occupier family home, which is still extremely rare to find. There is hardly any listings in the Sydney market, and that market is still strong and moving. You know, and then you've got the investor market, which is potentially dangerous, and then you've got the foreign investor market, which is highly dangerous. You know, the Chinese developers have come in and caused more issues than the foreign investor. The individual, no problems. The developer, big problems. Darwin is definitely in suffering, and it's been there, you know, waiting for that to happen for quite a while. Melbourne is still doing quite nicely. Again, split very much in two. Inner city, dangerous. You know, family style, large. Outside of the city, you know, very safe. Perth, I think, is crazy good value because it's miserable, miserable, miserable. And that's when I always like to buy when it's most miserable, because that's when I can discount and get the best value. So that's when you wanted to buy 4 years ago when Sydney was miserable. You got incredible value, and people forget the government was even giving you free stamp duty. In Adelaide right now, the government there is nervous, and they're giving free stamp duty up to the first 500,000. When you can get those concessions, take them, because they're stimulants, and you want to act on stimulants. So Brisbane, I think, is the best, you know, market for next to profit, and I thought that last year, and it's not letting me down there. It's all looking pretty good. So overall, that cycle is running true to form. It runs on average 7 to 10 years, and it's the same everywhere in the world, slow, medium and fast. And I'll just remind everyone that Australia is consistent because of our population growth. You know, everyone keeps building houses. The only reason you can move from cycle to cycle is if new people arrive to live in them. And that's why that population growth is so critical, not just the quantum, but the quality. And that's Australia's secret weapon. We have high quality migration, best in the world. You know, you've got to be very careful at the moment, at any time in the future, of too small. We call them stops, small, tall and overpriced. You do not want to buy anything that you would not live in yourself. It is dangerous, even in a good market, so leave them alone. To give you an idea of the numbers, here we go. You've got, you know, the overall weighted average of the country, 4% year on year, down from 9.8. So there was a natural slowing because Sydney came off the boil. 18.9 down to 3.6 for the year. Again, that's what we told you would happen, not because we were so wise to see it, because that's what a cycle does. You cannot grow at 18% growth forever. Everybody wishes that if they own a property. Everybody's scared of it if they don't. I think I jokingly said that the new definition of a bubble market, which is what they were calling Sydney, the definition was changed to a market that I forgot to buy in. That's what a bubble market is. If you're an owner in Sydney, you want it to go on forever, but it can't. No market can sustain that level of growth, so it naturally slowed down. And we had 2 negative quarters there. But again, you're seeing the effect of lack of supply in the housing, that its last quarter came back to positive. So we're not going to see a massive risk there of the prices falling off. They're just going to hold and slow their growth as should be expected. Melbourne doing quite nicely because there is massive undersupply in high quality area because it's the highest growth population in Australia. 100,000 plus, world's most livable city, everyone wants to go there. That's what happens. So that population growth is driving that and stabilising it. Brisbane's starting to get good, 4%, and that's what I'm saying. I believe that to be the next to profit market. I think that's the one where you can still get good value and you're going to get some nice uptick on the price. So if you're looking for a reasonable entry price, with a reasonable profit expectation in the near future, Brisbane still looks to me to be very attractive. And Perth is miserable, which means, absolutely find your bit of misery and get it at a fantastic price and then wait for things to naturally change over. But everywhere else is looking pretty normal. Darwin a bit soft, but these are traditional cycles. They come and go with great consistency all the time. The reason that I'm not worried about the underlying market is, again, you look at the reality of rentals. And you can see in Sydney, that market has a vacancy factor of just 1.8%. If we were worried about a bubble, it would be much, much higher than that, 5, 6, 7, 8%. But at 1.8, that's telling you there's not enough property in the market. And what they're building, unfortunately, is not enough of the market demand. They're not building enough larger homes, larger villas, larger apartments. They're building a lot of investor stuff. So we're not satisfying the demand, and hence the pressure remains in the market, and rents are still on the rise. Melbourne, to a lesser extent, it's at 2.7 because there is a large influx of new apartments, but the vacancy actually dropped year on year because 100,000 people did arrive and the population lifted. You can see Brisbane is starting to get a little bit better, it's improving, and you're getting slight increments in rent. And there's Perth at 6%. Now that's very, very bad by Australian standards. And you can see both Perth and Darwin with over 5% vacancy. The result of any time you see 5% or more vacancy in Australia is a softening of the rents. That's what naturally occurs. So those 2 markets, you could be saying, oh, that's fear. But to me, that's opportunity. Because when it's at its worst is when I can negotiate to my best. Now, I just have to lower my expectations of what I think I will get as a rent. A lot of that rent reduction was because people were getting too much during the good boom days. Our population growth in Western Australia, for example, was 50,000 a year normally, lifted to 80,000 plus. It's now down at 30,000 because that extra 30,000 that arrived just for the mining boom or for the sake are now leaving. We're still getting our 50,000 intake, but when those 30,000 people leave, 50 normal in, 30 out, minus 20, minus 30. That won't happen forever. Eventually we'll have got rid of all of those 30,000 that were coming and we're back at 50,000, you'll see soak up of that oversupply. But you still have to be careful what you buy, and you should get a great price if you're going to enter a soft market, because you need to factor in the risk. The risk is there. Now, apartments is something you've got to be very careful with in Australia because we're just evolving into that sort of living. We don't have that Hong Kong density, that Singapore density mentality. We still want big apartments in Australia. If we're going to be in an apartment, it has to be home-sized. It can't be microscopic. And that's, again, what they're building. And Australians are big people. We can't live in small places. So you've got to realise that, and this is the tale of many cities. You can see that the averages that we looked at before were very strong. Sydney had grown at 4%, 18%. But that's houses, not apartments. You can see it's still growing, 0.4% up in the apartments. And in the inner city, the average of the whole city is 0.8. But you can see most of that growth is actually in the inner city. Now, the reason for that is very simple. Living in Sydney is fantastic. You want to be close to the action. The travel and the traffic is horrendous because it's an old city with very bad transport routes. The train's unreliable, apparently. and therefore the closer you can be, the happier you are. So you can see inner city living in Sydney is preferred to being on the outer or the middle. That's where you want to be. Now the outer is now experiencing some high growth, mainly because people have given up and can't afford where they want to be, and they're going out and getting larger for less. That's a natural phenomenon in a peak of cycle. But it's not preferred. I'd rather be in the city, but I can't afford it, I've got to go out there. And that's just a natural phenomenon. You can see in Melbourne, the city's doing quite well at 3.9, but the inner city is underperforming. Now again, that's not because it's not a great place to live. It's actually the best place to live in the world, apparently. But the problem there is massive oversupply. They're building truckloads of super high towers that are super small and no one wants. So people are saying, I looked at it, it's no good, move on. And so what you're seeing is the middle is becoming more profitable and more attractive because it is more livable. I don't want to live in the world's most livable city in a horrible second-rate place. I still can get a tram down there quite easily. It's nice, good transport. So people are going back to good standard rather than substandard. You can't make someone do something that they don't want to do. And Brisbane, you can see, it's still in confusion mode a bit with apartments, but the inner city is becoming more popular, but you probably want to be city fringe. It's still not as attractive to live in the city. It's not as vibrant as Sydney or Melbourne, and hence why you're probably doing a little bit better on the outer, because again, transport routes there are much, much better. Now in Perth, you can see the inner city is doing far worse in a bad market than everywhere else, because I don't know if you've been to Perth inner city and stayed there, it's boring. Everything's closed. So everyone wants to live in the city fringe where the cafes are and everything else that are open, or houses that are nice and big, because that transport is also very good. So you don't want to be in Brisbane and Melbourne too much in a city, especially if it's too small. You've got to give me a reason to come there. But you've got to bear in mind that the apartments have to be genuinely livable, otherwise you're inheriting risk. And I can't say it enough, but please stop buying stops. Don't matter how good the brochure is, no matter how aggressive they tell you the potential is, if it's too small, if it's too tall, and if it's overpriced compared to what's in the market, you will not only not make money, but there's a high likelihood you'll lose money. And if you'd like to lose money, there are far better ways to do that, okay? Donate to charity, give it to a political party that might change its ways perhaps. So please, stop buying stops. High risk, high danger. You can see overall the Australian market has been very, very consistent and stays so. And you can see there's, Sydney, only 1.9% year on year, a natural slowdown after a very good period, but its 5-year average 9.68. 3 years of fantastic growth, one end not so good, one current year not so good. Average 9.6. The long-term average 7. In Australia you can see Perth is minus, Darwin minus, opportunity market, Brisbane underperforming, Melbourne's got room to grow. Whenever I see it under the historic average of 7%, it means worth looking at to buy. Over the average is risk. Very, very simple philosophy. And you can see they're all very consistent. So you don't have to worry about should you only buy Sydney or only buy Melbourne. Buy anywhere in Australia because they're all fantastic. It's just where is the best value and where is the least risk at the time of acquisition. Finishing off, I still think there's lots of upside for Australia. I think the property market is going to have a modest growth year and follow the traditional cycles. Sydney going to stay a little bit flat, but there's still opportunity in the housing market. Perth is greatly opportunistic, but you'll have to wait around a bit for your profits. Brisbane is next to profit, and Melbourne, in the safe housing market, strong demand as the world's most livable city. So you've got to be mindful of that. There's opportunity, but you have to go get it. Now, it's not just because I think Australia is great, but it now is probably, in all this craziness, the most normal of the crazy. So it's not so bad. We've got crazy things going on, but hey, have you seen that guy? He's even more crazy than us. And people want to be as normally crazy as possible these days. It still is the best place to bring up your children, live and enjoy yourself. It's not a work colony by any way, shape or form. You won't be able to get anybody to work very hard for you if you want to set a business up. but it's a great place to live and enjoy. So get down there. And believe you me, I do walk around this globe on a constant basis talking to people, and they constantly remind me, I wish I could live there. How good is that? I had such a great time. They're the things that you hear about Australia, and not too many other places. And last time I checked, there's about 6 billion people on the planet, growing by a fair chunk, I think 200 million a year. And I can tell you, their kids are most likely to want to live in a little island called Australia. So when they actually figure out where it is, God help us. There is risks. I'm not going to try and say to you, hey, don't worry, anything will do. You can't guarantee to make a profit just by buying an Australian property. You can't make a profit just by buying anything in the world. You have to make sure that you look at it, assess its value, make sure it's a good quality property and a good price. If you do that, your likelihood of success is probably the best in Australia. And those risks are very easy to see. Those small apartments are high risk. Bad areas, distance from the city centre, they're all natural risks that are very evident. You know, don't be talked into something that doesn't feel right. The biggest risk on the table at the moment is the fact that foreign investors of huge volume cannot currently get easy access to loans. It's been one of the hallmarks of our market. We were the only market in the world that had never closed lending to foreigners until just recently. That's sad. That's an embarrassment. And it's something we need to fix at governmental level, or if they're not going to do it, at SMATS level. So keep an eye out for the bank. You know, it'll need your help, you know, you'll need to support it, and you'll probably need it to get your next loan. So you better get on that bandwagon. There will be bad news, particularly in Melbourne inner city apartments, where you're going to hear about investors walking away, prices falling 10–15%. In Sydney, where some of them are not worthy and will come off. There's going to be lots of bad news like that, but that is natural at an end of cycle. What has always amazed me when you look at property, when people buy very expensive properties that are very substandard and then the valuations come in soft, they blame the property. They say, oh, don't buy a property, you can't make money. No, the truth is you bought a lemon. You made a bad decision. But no one ever owns up to the truth of that. You know, if you are buying, it's your duty, your responsibility to get the best deal possible on the safest property you can. It's not hard to do, you know, so make sure you put it in play. Now the good news is, when you hear bad news, that creates opportunity, because that bad news scares people into thinking the worst, into dropping prices, and so comes opportunity soon after. So don't worry about hearing bad news, welcome it. And trust your instincts. If you look at it and it seems like a fabulous property with great size in a great location at a pretty good price, fear not. But if your guts are saying, oh, I don't like this one, then please leave it alone. Don't buy a stop, buy something amazing, get a fantastic piece of Australia, keep safe on all your fronts, and just remember that it's going to get crazier before it gets normal, I think. And we should have a bit of fun with it and watch it. On that note, thank you very much for coming along.